It's a pleasure to introduce John and John Geanakoplos, and as I said, maybe give me an opportunity to embarrass him a little bit. John is quite a remarkable person. He manages to be both brilliant, open-minded, and very broad in his thinking. On one hand, he was the under 18 U.S. chess champion at age 15, one of the youngest people to become full professor at Yale. He was Ken Arrow's graduate student and wrote the entry in the New Palgrave's Dictionary on general equilibrium theory. So he's very much out of the cloth of the traditional economics. At the same time, he's been involved with the Santa Fe Institute since the very early days. He actually influenced me to start in a very big way, actually, to do what I did and get involved in as a practitioner. And John has been a practitioner in financial markets for at least 2 decades or more. And I think that's informed him enormously in terms of making him very aware of practical implications, where I should say the fund that he's the chief scientist for is extremely successful. I'm an investor, so they've made a lot of money for me in a very steady way. And by the way, they use a model that's extremely successful in predicting the future in conditional ways. But I think that's made John very open to different approaches and very practical in what he does. And maybe he'll say a bit more about this, but the reason he isn't able to be with us today is because, John's of Greek ancestry, and he's now helping his Greek ancestors out in trying to get out of the debt mess they're in. So John, please elaborate.
So yes, I'm very sorry that I couldn't be there, but I hope it's for a worthy cause that I wasn't able to go. So I'm going to talk about monetary policy and the leverage cycle and how my thinking's been influenced by complexity, or how I think complexity should be brought to bear on the question. So this is a slight caricature, but I think not far from the truth. The standard way of looking at macroeconomics, the one that you get from the newspapers, is that the problem of macroeconomics is too little aggregate demand or too much aggregate demand. And the role of the Federal Reserve or the central bank is when there's too little aggregate demand, it lowers the riskless interest rate. When there's too much aggregate demand and inflation, it raises the riskless interest rate. And there's some complications on the edges about what do you do when the riskless interest rate is already zero, and maybe you should be talking about forward riskless interest rates or so on. But that's the sort of first pass summary of how people conceive of macroeconomics in the Federal Reserve. And of course, it's getting much more complicated lately, but for a long time, that was the view. Now, if you have that view, what could you possibly mean by tight credit? You must mean that the interest rate is too high, but that's not really what people mean, that the interest rate's too high. What I think they mean is that people who want to borrow at the going riskless interest rate can't borrow because lenders are afraid they're going to default. So what's missing from this traditional macroeconomic view is default. So economic theory, I think, has to model trust and default in order to have a realistic view of credit markets. So if lenders are worried about default, they're naturally going to force borrowers to do something that's going to make the lenders feel safer, for example, putting up collateral. So once you think about collateral, you're led to compare the ratio of the value of the collateral to the amount borrowed. The higher the collateral versus the borrowed, the safer the lender feels. The inverse of that ratio is called the loan to value, the amount borrowed divided by the value of the collateral. And the lower that is, the safer the lender feels. So you might really, a more sophisticated version of a credit market, it might be a credit surface. You might think about the loan to value and the interest rate that is going to be charged by lenders depending on what the loan to value of the loan is. So if the loan to value is small enough, the lenders will feel safe and the borrowers will be able to borrow at sort of the same interest rate, no matter how much they borrow for a while. That you might think of that as the riskless interest rate. But as the interest rate gets higher, lenders get more nervous and they start charging a higher and higher rate. And the interesting borrowers are not the ones at the very left of this picture. I'm hoping you've been able to see my slides there. Is that right?
Yeah, we can see the slides.
Okay, so the interesting buyers might be crowded. They're not the ones to the left of A. Maybe the ones they're crowded in at A, and they're still borrowing at the riskless interest rate, but they're stymied from borrowing more because they realize as they start to try and borrow more, they're going to face a higher and higher interest rate. Maybe still more interesting buyers are to the right of A, and they're going to be paying. I mean, they're the ones who make the economy go. The ones who are actually taking on risk, and they're the ones that the economic policy should worry about. So the tightness of the credit market is not the level of the riskless interest rate. It's how far to the left or to the right A is, and how quickly or how steep the rising part of the credit surface is. And that's my fundamental point. So, macroeconomists don't really explicitly keep track of a credit surface, although a lot of policymakers might think in those terms, but they don't explicitly keep track of it. But the private sector definitely keeps track of it. So in this picture, I got a graduate student, the Fannie Mae and Freddie Mac now make loan level. They're the two government agencies that basically are now controlling almost all the loans, mortgage loans in America. They've now recently made loan level information available. So I got a graduate student to download all the loans in 2013, the last year that was available, because you don't know for a while whether Fannie Mae and Freddie Mac are going to own the loan. So anyway, the last available year that we could get. So he downloaded all the loans one by one, and he looked for every loan. What was the loan to value of the loan? And then a second thing, he looked at the credit score. So lenders, practical lenders, worry about the collateral. They also worry about how creditworthy the borrower is. So if you're a corporation, they're going to worry about your credit rate, your rating. If you're a borrower, they worry about a thing called the FICO credit score. So 800, like an SAT, is sort of the top of the FICO scores. And so in the near corner, if you've got very low loan to value and very high credit score, you can borrow at a very low interest rate on your mortgage. But as your FICO score gets worse and your loan to value gets higher, the interest rate you're charged goes up, and goes up quite substantially. Now, these loans are to the best borrowers in America. They're the ones with houses. They are sort of middle to upper middle income people. There's a maximum size, and they have to have jobs and all kinds of paperwork. And these are the best possible borrowers. And even for them, you can see the steep rise in the interest rate as FICO goes down and as LTV goes up. If I had included the subprime, Alt-A, other kinds of loans, you would have seen a much more dramatic rise in the credit surface. So the different borrowers are treated very differently. Now, if you compare 2013 to 2006, the peak of the market, you would have seen a very different story, but I'm going to skip that and go to another picture. So here we have Lending Club. Lending Club is a rapidly growing online lending service, which actually I heard about at Santa Fe. I should have invested in the club when I first got told about it 5, 6 years ago, but I didn't think to do that. In any case, you can get all their data. It's also publicly available, all the loans that are made, and it's private people online lending to other private people, being informed of various characteristics. So I got an undergraduate this time to download the income, which turned out not to be that interesting, and the FICO score again for every borrower in Lending Club. And here we have the credit surface. The interest rate is a function of FICO and income in 2012, the beginning of first half of 2012. And you see the interest rates are much higher because there's not collateral. These are less fabulous borrowers. It goes up to 20% for people with lower FICO scores instead of 5% like it was before. But what happens in the second half of 2012? Well, you can see it's starting to go down. And in 2013, it's gone down even some more. In 2014, if the second half of 2013 stayed the same, 2014, first half, it goes down more. And 2014, second half, it goes down even more. Now, what better indicator can you have to describe the credit markets in America? This is the way that the Federal Reserve, and I think all of us, should be looking at the credit markets and their tightness or looseness. And this explains, I think, to a great extent, why activity is picking up in the U.S., at least it was through 2014 and 15. So I'm now going to describe a little bit about how to model. Well, I'm going to continue about the leverage cycle. So what is the leverage cycle? The basic idea of the leverage cycle, which I It's a long-standing theory. The basic idea is that when there's a long period of low volatility in financial innovation, the lenders feel safe and they invent new ways to lend with higher collateral. So they feel safe, they create more instruments, and they allow leverage. The credit surface gets flatter. And when the credit surface gets flatter, more people take advantage of that, and leverage goes up and credit standards go up. People with a steep credit surface are prevented from doing that because it's not, the incentives prevent them from doing it. The interest rates are much too high if they try to borrow at too much LTV. But if they can borrow at the same LTV for more and more LTV at the same interest rates, they're going to do it. So you'll see increased leverage and laxer credit standards. The main point of the theory is that raises asset prices and increases activity, as I'm going to say in a minute. But it also makes the economy more vulnerable. For example, borrowing goes up for a squared reason. You borrow a higher percentage. Instead of 80% of a house, you could borrow 97% of the house, but then the house goes up in value. So you're borrowing a higher percentage of a higher value. So there's a lot more borrowing in the economy, and the economy is much more vulnerable. Then when there's scary bad news, the scary bad news causes the lenders to completely change the credit surface abruptly. And now it gets very steep. And all of a sudden, borrowing crashes, and that makes asset prices crash and activity crashes. And then there's a variant of the, CDSs I don't have time to talk about. But this is disruptive to the economy. Someone said earlier in the session that, these business cycles don't make much difference. The last business cycle made a great deal of difference. So the Fed's thought all along it should smooth the credit cycle by adjusting interest rates. I'm saying it should smooth the leverage cycle by restraining leverage in booms and maybe propping it up when things get too low. And the final part of the leverage cycle, which is actually what I'm concentrating now on in Greece, is that if at the end of too much borrowing and after the crash, the asset prices are so far below what's owed, the lenders aren't going to get their money back anyway, and everybody can be made better off if forgiveness is practiced. So let's just see how this has worked out in practice. This picture is from 2000 to 2009. It's Schiller's famous picture, the green line on the right-hand axis, where housing prices went from 100 in 2000 to 190 in 2006, and then they dropped 30 or 40% from there. So a 90% rise in 6 years. Incredible rise. Now, he attributed this to irrational exuberance. But if you look at the average down payment on non-government loans, so it's the loan to value. So it's at, if you measure the down payment, 100% minus the loan to value. So from the top, it's the down payment. You see it's around 14%, 13% in the first quarter of 2000. And then it goes to 2.7% in 2006. In fact, the exact same quarter, housing hits its peak. Loan to value hits its peak. Then loan to value collapses and housing prices collapse. Schiller, as I said, attributed it all to irrational exuberance and then a changing narrative of the irrational pessimism. But I'm trying to connect it to leverage. Okay, now in the next diagram, you see not the housing market, but the mortgage securities market. And these are mortgage bonds. So the red line, again, this goes now back to 1998. So the red line is an index of the price of these average Alt-A, AAA mortgage bond. And you see it's around, on the right-hand scale, it's around 100 till the crisis of 2007, when it drops dramatically to, tremendous drop to 40 or so, and then it rises back to 70, and this is up to 2014. Well, nobody kept track of these leverage numbers, but my hedge fund did. Because I was interested in it, I guess. And so you see the blue line is on a representative sample of mortgages that we could buy, and we kept track of what terms we could have borrowed on. You see that the down payment would have been 5%, 95% LTV. In 98, there was a crisis. That's when long-term capital, a famous hedge fund, went out of business. And suddenly leverage went way down, but it quickly recovered and went back up. And then sort of in the middle there, it went from 10%, so I was 10% down payment. Then I went to 5% down payment. And then just as the crash was happening, there was a tremendous drop in the LTV you could get for borrowing on these things. Lenders felt nervous and they wouldn't let you borrow very much money. And now you can see that the loan to value has gone back up as the prices have gone back up. So I'm not asserting that there's a one-way direction that leverage is determining prices. I think there's a back and forth. It's a general equilibrium that as prices go down and lenders get more nervous, they reduce the leverage and so on. But there's a tremendous correlation between leverage and prices. So if you look at the next slide in what's happened across countries in housing, this is done not by me, this is done by San Francisco Fed. You look across many different countries in 1997, what was the debt to household income in the different countries? And then you look in 2007, the red. And so you see, like, for example, Ireland on the right. Between 97 and 2007, there was a tremendous rise in household leverage, you could call it. You look at Spain and Portugal in the middle, a tremendous rise in household leverage, and Denmark too. But if you look towards the left a little bit, in the middle, you see Germany and Japan. They had a drop in household leverage between 97 and 2007. Now, if you look at what happened to prices between those two dates, you see that there was a tremendous, on the horizontal axis is leverage, household leverage. On the vertical axis is what happened to housing prices. And you see Ireland way off on the right and Spain way up there. And then in the bottom left, you see Germany and Japan. No increase in leverage, no increase in prices. So if you look at the same countries and you look what happened to their GDP after the crisis, you see the big drops were in these same countries, Ireland and so on, Denmark. And you look at Germany and Japan, they didn't lose any. Germany gained after the crisis, and Japan only lost a little compared to the other countries. So you see the effect of leverage on prices, on activity, and on the economy, both during the cycle and after the leverage cycle. Well, this isn't an entirely new idea. You know, Shakespeare, I don't have time to talk about it, but you can read Shakespeare as having had the whole idea, including the forgiveness, by the way, that I'm going to talk about. It sounds even like common sense to me. But it's common sense that the Fed still hasn't, and the ECB still haven't incorporated, although they're moving in this direction. But I would say that you should empower the central banks to regulate leverage, not just adjust interest rates, put endogenous leverage and the whole credit surface into large macro models, and destigmatize default and forgiveness. So more concretely, I think the Fed should be mapping out the credit surface. They're in the best position, the central bank and the Fed, to gather all the data from banks about what are these offer curves. And you can do it not, for different asset classes, for mortgages and for corporate bonds. You'll get different leverage surfaces. And if the investing community knew the leverage surface, they'd be much better informed. I recommend that the central banks couch their analysis in terms of which part of the credit, most central bankers understand when they lower the interest rate, they're affecting the rest of the credit surface. They're making it easier for risky borrowers to get money too. And they know the credit surface is not moving in parallel downwards, it's probably tipping in some way. So they know this without ever explicitly talking about it. They may talk about it privately, but they don't put it explicitly into their models. I think they should be forced explicitly to couch their analysis in their public statements in terms of the credit surfaces. Thirdly, I think they should actually intervene directly in the credit surfaces, just like the Central Bank of Israel said that you can't, when housing prices got too high 5 years ago, 4 years ago, Stan Fisher said, who's now the number 2 guy at the Fed, he was the head of the Israeli Central Bank. He said, no one in Israel can borrow more than 60% from an Israeli bank loan to value on a house. Or the Fed during the crisis, they loaned at LTVs that no private sector would do when the markets were collapsing. So finally, if the whole analysis is in terms of the credit surface and people realize that there can be default, that's the point of the credit surface, that's why it's upward sloping, then banks would be forced to recognize the possibility that they can't pretend that there's no chance of default. Once they realize there's a chance of default and they think about how much money they're actually going to get back on their loans, they'll come to realize that forgiving a loan can actually make them more money than they would have gotten otherwise. So once you recognize default and recognize that the loan is really not worth 100, you're almost inevitably led to think about the possibility that partly forgiving some of it could get you more money, and everybody would be more inclined to forgive if they thought it was in their own interest. So just to give you an example of the U.S. credit crisis in 2007, we had there were subprime loans. The whole crisis began with subprime loans. People with bad credit ratings, those are people who will walk away from their house if the house is worth much less than the loan. So for example, at the bottom, if you have a $160,000 loan and the house is only down to $100,000 in value, why pay it? So it turns out these subprime borrowers, they were always kicked when they defaulted, which most of them did in this case, they were kicked out of their house. But the recovery on the loan, and now we have $400 billion of defaults, so we can measure very clearly what the recovery was. It's not just a conjecture or a small sample, it's a staggering amount of money. 23% was the recovery in this kind of case. So that's 35,000 out of the 160,000 the lender would get back. Why is that? Took 2 or 3 years to kick the guy out of the house, during which he didn't pay his mortgage, he didn't pay his taxes, he didn't fix the house, he had to hire a realtor to sell it, etc. If you'd forgiven 160 down to 90, you'd probably get the 90, or else the homeowner would sell the house for 100, pay you the 90 and take his profit. You could have made more money by forgiving part of the debt. Okay, so we didn't do that, and I warned that all the other policies of lowering interest weren't going to work, and they didn't work. All right, now just about modeling, I want to say a word about how to model all this. Complexity's already played a role because you have to keep track of many borrowers, and they're all heterogeneous, and that's why you have a whole credit surface and not just one number, the interest rate that one guy is taking into account. Crucial thing is, why do prices go up when leverage goes up? Well, the reason is that if you think of a heterogeneous crowd of buyers, the natural buyers at the top, ranked by how much they want to pay, whatever the price is, there's going to be some marginal guy who thinks it's a fair price, and the buyers are going to be the people who think the value is higher, and those sellers are going to be the people who think the value is lower. So the marginal buyer is going to think the price is fair. As you increase, the people above them are going to think they're getting a steal. They'd like to buy more, but they can't because they can't leverage enough. So if you increase leverage, the people at the top are going to be able to borrow more. You'll need less of them to buy all the assets, and the marginal buyer is going to go up, and you're going to have a higher price. Okay, and there are lots of reasons for heterogeneity: different risk aversion, different risk tolerance, different, people can use the assets differently. Some people like the houses, some people don't. Some people are more optimistic than others, etc. So to be very concrete, you could imagine that there's an asset that pays 1 and some number like 0.2 that's below 1, that's asset Y, and another asset that's perfectly safe. The heterogeneity might come because different agents attach a different probability to up or down. So agent H attaches probability H to up, and the biggest optimists are sure things are going to go up, and therefore Y is a very valuable asset. The pessimist thinks things are going to go down, and Y is not such a valuable asset. If you didn't have, in this exact model, when people own one asset of Y and X, and there's a continuum of people, if you had no borrowing, okay, then you'd have to buy Y by selling your X. And you'd find that there's a marginal buyer and there's a price, which isn't going to be that high. It's 68, and the marginal buyer is 60% up. Now, suppose you introduce the possibility of borrowing, but with limited trust. You had to put up collateral. That's the only way people would trust you. And you're always going to deliver the minimum of the collateral value, that is the 0.2 in the bad state, and what you owe. Okay, then what will happen? Well, people foreseeing this, 1 minute I'll be done, foreseeing this, if the collateral is worth something good in the upstate and much less in the downstate, but you're not borrowing very much, the red, you're going to deliver everything. If you're borrowing much more, trying to borrow much more, making a much bigger promise, you're going to break your promise in the bad state and walk away from it. And so everyone will anticipate the payment to be the green thing, which is much less than you're promising. So people have to look at the future. If you promise this thing, the max min number, it's the most you can promise without breaking your promise. And so if that's the amount you can borrow, then people will be able to borrow. The optimists you don't need as many of them. The price goes up to 75. Okay, so the question I'm about to finish, sorry, I don't know how much time I've taken. Am I beyond my time?
Yeah, it was 20 minutes. I'm not sure that was made clear in advance, but I think you take a few more minutes and wrap up.
Okay, so I'm right at the end here. So the question is, the more you're able to borrow, the higher the price is going to be. How much can you borrow? What's the equilibrium in the market going to be? Well, everybody's looking forward and trying to figure out who's going to default and how much they're going to default by. And so you're going to get a credit surface. In fact, this picture, the same one I showed before, is the actual credit surface derived from this model. And it turns out in binomial examples, all the people will trade at A. So it's very simple to solve for a binomial economy. And you can see that depending on the volatility of the asset, that kink point moves to the right when the asset's safe, and it moves to the left when the asset moves around a lot in price, and people can borrow less. Okay, so the punchline is, how do you get a leverage cycle? You can imagine a multiple period model where at the beginning, things, this is the same asset that can pay 1 or 0.2 at the very end. But now there's an in-between state where you find that things are great and it's going to be 1 for sure, or you get bad news and now the 0.2 is a real possibility. The point is, at the beginning, there's not that much volatility. The news is limited how bad it can be. And so you're going to be able to borrow a lot of money, and the price is going to be very high of the asset Y. But after the bad news, if there's a 1-period loan, people now realize that there's a clear and present danger of something going wrong very soon. And so the amount of borrowing is going to abruptly drop. And so what you're going to find is that the marginal buyer here is 87. 13% chance of going here, 13% more there, so less than 2% of getting down here. Okay, so he thinks the thing's worth 98. And then once things go down here, you can suddenly borrow a lot less, and the people who are leveraged lose a lot of money. So the same marginal buyer, his opinion went from 98 to now a 13% chance. So of course, his opinion went down. He thinks it's now worth 87 plus 2, so he thinks it's worth around 90. So he went down by 8 points, but the market's going to fall much further than that. It's going to fall all the way to 69. Because it's not just the bad news; it's the fact that nobody can borrow anymore, and the credit surface went from there to there, and that's what really crushes the market as lenders get more nervous. So to conclude, the conclusion is that the economy, you can model this. You have to take into account many different borrowers and lenders and the heterogeneity, and you have to think what each guy is going to think about the future and how they're going to lend or borrow. So I've done it in a perfectly rational model, but you could imagine doing it in a sort of complexity model, agent-based model, where you don't impose so much rationality, but still the forces of lending and borrowing and people worried about default will inevitably give you a credit surface, and you'll see that as things get more dangerous, lending is going to be curtailed, and that's going to have a huge second impact on the markets, and that's what has to be smoothed out by a central planner. Okay, I'm done. Sorry I went over.
Thanks, John.
Geanakoplos, but please thank our panelists.